Hello, everyone. Can you hear me well? Yes. Hello, everyone. I'm so sorry, you are probably tired. I promise I will be brief without any impact in the quality of the speech, I promise. For me, I'm very proud to be here in the 10th anniversary. Congratulations to Valuespain, to Christian and the rest of the team. I'm very proud to be here with all of you presenting our idea. Well, this is a legal notice you are supposed to read if you have time. We don't have many time. So the company going directly to the presentation, to the pitch. Okay. I'm going to talk about Semapa. Semapa is a company trading in Portugal. It's a holding, an industrial holding company with some assets behind. It's a quite singular, as it's not the typical holding because it has just a couple of assets behind, underlying assets. There's just a couple of them. The most important one has to do with paper business unit, with the paper industry. Basically, printing and writing paper. They own 17% of shareholder capital of another quoted company in Portugal, the Navigator company, which represents 72% of total sales of the holding. Probably most of you, I'm looking some printing papers on the table, so it's a good thing for the speech in order to work. They produce and sell the well-known branded printing paper Navigator. They also produce and sell kitchen and toilet absorbent papers under the brand of Amos and many other paper-based kind of products. The other business unit they have, and in this case they own 100% of interest, has to do with materials and cement. They control the Cecil cement company, which represents 26% of total sales in the holding. And the third assets under the umbrella of environment, waste management, and other small private equity investments, wholly controlled by the family, by the holding, representing just 2% of the sales. As you can imagine, we are going to spend more time trying to understand the most important underlying asset, which is the Navigator company, and is where the investment case of Semapa lies on. Fourth, quick things at a glance of Semapa. First, we are talking about a family business. Family business. The company was IPO'd in 1991, and since then has been owned and managed by the Queiroz Pereira family, right now controlling 83.2% of the capital shareholder, or the voting rights is important. Second point, and this is a kind of a, how to say this, a caveat or a warning, is a small cap. We are talking about a company about 1.1 billion market cap with low liquidity. The daily average volume is hardly ever is above 500,000. So probably this is not an investment for everyone. When it comes to a holding company, it's worth having a look at some value creation metrics. It's like investing in a similar to an asset management company. So we have selected here, we want to see later on more metrics. We have selected here some, thank you. Some metrics over the last 10 years. The company has paid back to shareholders $500 million, is close to half the current market cap. And the total shareholder return over the last 30 years, since it was IPO'd, has been 13% compound, 13% compound. Here you have the chart in your right side. We are not talking, I have to admit, we are not talking about Berkshire Hathaway, we are not talking about Investors AV, this kind of superstar mega holdings. But putting this into the context of investing in a small, mid holding in Iberia, in Portugal, compared, for instance, to the return achieved by the market, is more than acceptable rate of return over the years. Last but not least, another interesting feature, valuation-wise, cheap is optically cheap, 7 times earnings on 6% dividend yield, And according to our numbers, with a cumulative expected, according to our numbers, I insist, of free cash flow generation up to 1 billion, which is around its current market cap. So what happens here? What's the proposal here? What catches our attention? The reason to present the idea today. This holding is trading at very high discount, all-time high indeed, close to 60%, 58% versus net asset value. We're going to see later on how we reach net asset value. It's not that complex to reach net asset value in a holding, as you can imagine. It is both above European peers and its own history of 35 discount. Here at the left side, you have the historical discount of Semapa related to market price, all-time high. There were two occasions in the past, 2015 and just after the pandemic or during the pandemic, when it reached similar levels, but not as higher as is happening right now. And as I mentioned before, this is the evolution of a bunch of peers, or holding peers, small mid-cap peers of holdings in Europe trading at 35%. So before going deeper to the value proposition, what we are seeing here, it's worth spending some time trying to understand the dynamics of its main assets. And the main assets, by large, is the Navigator company. In our opinion, how to say this, we think that this is a kind of the gem or of the crown of all the holdings they have. First, and it could consider as a competitive edge by itself, is we are talking about a fully integrated paper producer. From controlling or having access to forest is important, it's very important, to being able to produce its own paper mills facilities to produce pulp, the main input to produce paper. They have capacity 1.6 million tons, up to 1.6 million tons, both in pulp. Is the main input, raw material to produce paper, representing 13% of sales, as well 1.6 million tons maximum capacity to produce printing paper, printing and writing paper, unquoted wood-free paper, 63% of sales, the main activity. Tissue is toilet paper and kitchen-related paper, absorbent paper, or specialty paper, 0.4 million tons, 15% of sales. And finally, energy. So, why I mentioned that this is an interesting first competitive advantage. Being integrated, you can imagine once you are integrating the whole value chain, you are retaining all the margins that other players are gaining from the forest, the procurement of wood, from the production of pulp, tissue, and specifically as well in energy. You are fully self-sufficient when it comes to the energy needed to produce or to operate all these parts of the business when it comes to paper. Probably this is one of the most interesting slides or charts trying to understand, that help us to understand another important competitive advantage that the company has or enjoys, is that this is the cost curve of the European paper producers. Okay. Spread by quartiles. As you can see here, the red, close to be a cycle, I think it's a long cycle, red one. This is the capacity where the Navigator company has presence. You can see here that almost the whole first quartile is taken over by the Navigator company. It's the lowest cost producer. On top of this is as well the largest one. Being the largest one, lowest cost producers, gives them to be the undisputed market leader and to have the ability, this is one of the most interesting things, to fix prices. They are the absolute price setter. Indeed, right now, as we are speaking, they have announced a 5% increase in printing paper for this year, on top of another 5% increase early this year, in January. This is the selling price set or fixed by Navigator. easy to understand the difference between the cost of producing 1 ton, 1 ton of 1 million ton of printing paper for Navigator is 600, making more than 1,100. They're making very roughly, a rule of thumb, for every 1 million ton of printing paper produced and sold, they are making, roughly speaking, 500 million on EBITDA. Okay, this is the metric. You can see here that roughly 15%, close to 20% of the market is operating at a loss, some of them at a big loss. It has implications, as some of the competitors are exiting the industry because they are losing money. Second thing has to do with the big change of the cost curve. The competitive environment has changed dramatically recently over the last 2 to 3 years. This is the green line, the green curve is the former structure of the cost curve of the European paper producers. You can see that a strong upward movement has happened due to incremental costs in every single component of the total cost you have to pay if you want to produce your paper. From labor cost, has to do with the inflationary process we are living in, energy, electricity, raw material procurement, wood, chemical, and energy. So again, being a fully integrated producer as the Navigator company is, allows them to keep all these energy factors well under control. The Navigator company, according to what we were mentioning before, is the dominant and most profitable player. Why? Why they are able to operate at this lowest part of the curve we have seen before? Because they are operating the largest, size matters, in this kind of highly capital-intensive kind of industries like paper is. Being the largest one matters, and matters a lot, makes the difference. When you are selling a commoditized kind of product, the only way to differentiate yourself from others is being the lowest cost producers. You are offering the very same product, although they have a very well-recognized brand, is Navigator, but what really makes difference is being the cheapest producer. They are able to do this because they are the largest one and they operate the most modern mills. Look at this right-hand side. It's very interesting. This is the spread of competitors in Europe. The Navigator company is absolute reference, absolute leaders with just 2 paper mill facilities. Look, this interesting thing. Just one Figueira da Foz is one of the paper mills they have. Only that factory, the paper mill factory, is bigger than the second largest producers with these two paper mills factories they have. I'm talking to Silvano. So 27% of market share, almost close to 1/3 of the capacity in Europe. They are absolute undisputed number 1 in printing and writing paper, 2 times the second largest. This allows them, you can be the biggest one, but so what? If you're not able to make money on your assets, we are talking about, remember, a highly intensive kind of capital structure. Size matters a lot. This is a typical example of economies of scale fully working, fully at work. They are able, in this regard, to deliver, to achieve 25% margins, EBITDA, very well above peers, or the second best, hardly ever reaching 15%. On top of this, very interesting dynamics when it comes to supply, and it's related to what we were looking at before in the cost curve. All those players operating at cost, losing a lot of money, are exiting for good, not temporary closing, but closing for good. Capacity is expected in the red square. The 4th and 6th operators has been already announced, and is going to happen across this year, to close capacity, 10% of capacity, on top of 15% capacity closed over the last year. We're talking about 1/4 of the industry went out totally. So these natural or structural competitive advantages and the new order, new normal in the supply, the offering in Europe has made that Navigator has improved even more the profitability profile due to the size, as we were mentioning before, industry cost increases, and the exit of some of the competitors. Briefly, other business units within the paper, within Navigator company, growing opportunities. Tissue, they are growing, or they are catching the growing trend in the long term of tissue. They have become the second largest tissue producer in Iberia. They are investing heavily and taking big part of the growth with new trends of paper-based value-added products. For instance, all these paper-based packaging is a good substitute for single-use plastic recipients related to food. This is a trend they are catching. Or, interesting in my opinion as well, investing upstream in the procurement of wood, investing in Mozambique in a plan of new eucalyptus, of new forest. Let's see, Cecil Cimentos is a materials and cement company with 9.75 million tons per year of capacity, spread among different countries, but honestly speaking, here you have the bridge, the EBITDA bridge of the different countries. The most important representative and profitable geographies where they are operating are Portugal and Brazil. Indeed, in Portugal is quite singular market, it's a small one. They operate there 4.25 million tons of capacity. Is interesting because it's a quasi oligopolistic kind of market. There are mainly two operators sharing each half of the market, so you can figure out the implications when it comes to fixing prices and managing volumes. It's pretty much stable kind of business, Cecil Group as a whole, with a strong and predictable free cash flow generation across the cycle. Well, let me come back to the case. Having said all this, well, but the company, the Semapa holding, is trading at a high discount, this 58% discount, and measuring more metrics, or taking into consideration more metrics to, as I mentioned at the beginning of the presentation, to assess how good the management of a holding company is allocating capital. You should look at the track record and some metrics, interesting metrics to measure how good they have been managing the holdings they have. We have picked 3 of them. We mentioned before dividends. Over the last 10 years, they paid half the current market cap in dividends. Probably most interesting, we like this figure at Magallanes pretty much for every single company, the growth in book value over the years. And this is the cumulative, the annual compound growth of the book value of Semapa has been 13% compound. Remember that the total shareholder return you got being investor of Semapa has been, what a coincidence, 13% as well. So it reminds me that if the company fundamentally does well, the stock eventually follows. So we think these are very good trackers to measure the capability of the management allocating capital. Last but not least, free cash flow. The cumulative free cash flow over the last 10 years has been twice the current market cap of the company. Well, again, but it's trading at a high discount. And Semapa's management, and we enter in the key things of the thesis, they know that. Of course, they know that. And they want to take the opportunity to profit the situation, I would say, to squeeze out minorities. This is the stock evolution of the company over the last 10 years. You can see here the effect of COVID. They tried twice in the last 10 years to take over minorities, to squeeze out minorities. First attempt was 2015. Second attempt was pretty recently, after or during taking advantage of the high discount during the pandemic or the post-pandemic world, the second takeover bid, but at the end hasn't been that successful strategy. They increased a little bit, but total control they have right now, voting rights is 83.2%. Two things happen at the same time when they try to take out minorities. Once, and probably you can guess this if you paid attention to one of the first charts of discounts, these attempts to squeeze out minorities happen during all-time high discounts of the holding. And second, when the underlying asset, specifically the navigator company, was entering in an upward cycle, increasing prices, reducing supply from less competitive operators. So it is not a coincidence that they are launching these attempts every moment in time. It's very specific timing. What will happen right now? Who knows? This is my guess. Would make sense to try again to take out this 17 or less than 18% free float. Valuation, it's very easy. I'm not adding anything relevant here. Achieving a net asset valuation for a holding company, being prudent, conservative with every of the single separate, it's a sum of the parts, separate businesses. You have a navigator that in a per share statement is we value that at 28 euros per share. We are using two metrics, average EBITDA multiples and free cash flow to the equity of 12.5%, very conservative, below average. For Cecil company, we are valuing at 3.8 euros per share. We are using 5 times EBITDA and replacement value per installed capacity. Most of the value has to do with Portugal. We are giving almost no value to the rest of the countries, and very residual the rest of the assets value at acquisition cost 5 times EBITDA, 3 times. Taking out debt at the holding, that by the way I have to say that is very conservative, very low, and also taking out or removing holding cost. And I think it's worth mentioning that they spend less than 1 million per year in managing the holding for a company, according to us, has a net asset value of 2 billion. It's a pretty conservative approach when it comes to holding costs compared to other holdings. Worth mentioning, I would say. So, net asset value, putting all this in the milkshaker, 32 euros per NAV. Company is trading 13.5, and you get the discount we were mentioning before. Final remarks. I wrote down here possible solution, who knows. Remarks, we are in front of a acceptable, well-managed family holding according to the metrics, value creation metrics we've seen before. They've done okay to well allocating capital according to the metrics. Second, they are trading at, in our opinion, unjustified high discount. There are two possible reasons, two possible pushbacks. For me, the most Negative one is illiquidity. I mentioned before, it's an important caveat. It's not an investment for all kind of investors, not definitely for the big investors of this world. It's a small cap, it's a holding, it is illiquid on a daily basis. There is almost no coverage, sell-side coverage, almost 2 analysts, local analysts covering the company. Is totally overlooked for international investors, even for national investors as well. There is a bunch of investors. We own 1.1% of shareholder capital among other investors, most of them based here in Spain and Portugal. So real free float probably is less than this 18% official free float. So illiquidity, I think, is the main pushback. Reinvestment risk is another pushback. They are generating tons of free cash flow on a yearly basis, and they have the temptation to do silly things, probably. The end game proposal is a potential solution. I had to say another warning. We are not how to say this, activist investors. You know, most of you know Magallanes. We are a long-only value investor company, 3 billion under management, managing companies for the very long term, aligned with the main shareholders, family group control, and so on. So we are not there to fight against, okay? But we see value opportunities, value windows, and we share with other shareholders and with the main shareholder, with the family, a possible solution of this, how to say this, blockage. Because somehow the discount is so high that I think we've reached a blockage situation. So we know the family wants to delist the company to squeeze out minorities, and I know as well that they want to pay the net asset value. I have to say as well, we are not that naive to think that we don't play when investing in a holding. We don't play the easy narrative, close the gap strategy. Hardly ever, my experience. And in my opinion, it's not the proper way to approach an investment in a holding, to waiting until the gap is closed. No, it is not. It's trading most of the holdings as at a discount, and you have to look and to play with the degree of discounts, okay? Possible solution would be to offer something in the middle, something between. The gap is so wide, has widened so much, that something in the middle should be possible. This is an example. This isn't a firm offer or proposal. But for instance, it would make sense. It would make sense coming back to the historical discount, 35% discount. Okay, you are not willing to pay a lot of money you've never done before to pay or to close the gap to 58%. But what about 35%? To reach an interesting and technical point here, the Portuguese regulator gives you the opportunity to activate the automatic squeeze-out mechanism. It means, and in other jurisdictions in Europe as well, not in all of them, but many in the European Union, once you reach 90%, so you have to talk and to reach an agreement with the 6% real free float to 90% you don't control, the effort is not that big. Once you reach 90% of voting rights, you are allowed to launch automatic squeeze-out mechanism at the same price, of course, or the bid offer, to take full control of the company. Interesting detail here. What would this imply? This would imply Semapa offering around 20-21 euros per share. Is an interesting premium of 50% versus current levels, which is something that the company is affordable for the company. They could do that. We are talking about 280 million. They are generating capacity to generate, as we saw at the very beginning, 1 billion free cash flow accumulated over the coming 5 years. They can afford that. They can do a combination as well, as they tried the first attempt in 2015. They swapped, offering to swap Navigator shares into Semapa shares, or a combination of both. It's a possible solution. And it usually happens when the discount, remember, is high, and when the underlying asset, specifically the paper business unit, is entering a positive earnings cycle. And that's it. Thank you. I don't know if we have time for questions.
Hi, thanks for the presentation. Where do you see Navigator in the cycle now?
I cannot see you. Sorry.
Yeah.
sorry.
Yeah. Where do you see Navigator, the paper company, now in the cycle, or in the next 2-3 years?
Sorry?
Where do you see the paper company in the cycle now for the next 2-3 years? I mean, you talked about competitors leaving, but also the demand side.
Yeah. The cycle we are entering, this printing paper in Europe is a cyclical industry by definition. I see the dynamics very positive, as you are mentioning. We have seen first time ever this so big amount of loosey competitors are exiting forever. This is paramount. In the past, they were entering, their temporary closing, they are exiting, but they are returning. They are closing facilities forever. So this is a transformational movement. So first thing. Second thing, this is a kind of a last man standing play. The lowest cost producers in a so-so kind of businesses, we are talking about printing paper. Printing paper is not a product with an explosive expected growth, are going to be able to reap the benefits as long as you are the lowest cost producers. You are taking out the loosey ones, the loss making. You are gaining efficiency, as Navigator is doing, becoming more and more efficient. You are the big winner of this new structural transformation, new market as we've seen before.
Congratulations for the presentation. I have 2 questions, if I may. Yes. The first one is seeing exactly the 2 past bids. What tools do you have to defend yourself if the Queiroz family wanted to delist it at, as always they try to do, at an unfair price? And second, seeing the size of your asset management company, why not buy more and try to, of course you're not activists, but try to have a bigger position to try and be active on the solution?
Yeah, the two, I think, interesting questions, and this is the challenging questions we ask ourselves. What are we doing here? We are patient investors, but for how long? Well, at the end, we are patient investors. So, and the 2 questions are pretty much related, or I'm answering pretty much related. There is a big possibility, big possibility, the family is not interested, not even at this proposal. I can guess. Well, in the meantime, we are there. We are patient investors, and in the meantime, we are sit with them. We are aligned. We are sitting in the same boat, and we are receiving, don't forget that, dividends as well. So it is not a bad outcome if the main one is not successful. Being there, receiving dividends, we are okay with that. And buying more shares, yeah, we are a big company. We are a big asset management company. Is not an investment to have in a big fund, and we are okay with the position we have, because as we are not activists, at the end is a financial investment. So coming back to being patient is okay. It's an important holding in the Iberian fund. We have it in the Iberian fund. The Iberian fund is like close to 300 million. We are okay that, and we are willing, or we can wait, and in the meantime receiving dividends. ¿Había otra por ahí?
Anybody else?
No. Okay.
No? Thank you so much.
You're welcome.